Pranjul Bhandari, Chief Economist India at HSBC Securities, now joins in on the show. Thanks very much for taking time out. Pranjul, would you reckon that the kind of economic damage that has been caused due to the lockdown has been much worse in India as compared to any of the other countries in Asia? What are you penciling in by way of the GDP number for Q1?
Yes, good morning. So look, it's been a rather tumultuous quarter. We've seen a once-in-a-century pandemic. We've seen an extremely stringent national lockdown. And then we've also seen the pent-up demand once the lockdown was eased. All of this in one quarter. So it's going to be very interesting and very exciting to see what this one number, GDP growth, will encapsulate and where it will come. Now, in terms of growth forecast, we think the CSO will announce a number which is close to 17.5% contraction. But eventually, a couple of quarters or perhaps a year and a half down the line, we think this number will be downgraded to closer to 25% contraction. And I'll tell you exactly what we think is going to happen. The way we collect data, we don't have a real-time estimate on the informal sector. For real-time data, we use formal sector to proxy for informal. This is fine during normal periods, but this is not normal. This is a time when the informal sector has done much worse than the formal. And therefore, if you use that practice, you actually tend to overestimate growth. So we think it's going to be an overestimated growth. It's going to be somewhere close to 17.5% contraction. But a couple of quarters down the line, when the informal sector survey is available, this number will be revised down to 25% contraction.
Okay, fair enough. That's the view coming in with respect to what we can see this time around. But how are you looking at the kind of stimulus packages that have been doled out? At the start of the lockdown, you had that massive $266 billion, those credit guarantees on bank loans, etc. Do you think that it's still a long way before we actually see consumer demand in the manufacturing sector recover? And what more would be needed from the government?
See, we have to be very clear about the fact that even before the pandemic, the balance sheets of most of the economic entities in our economy was stretched. So you had corporates with too much debt, you had banks with too much NPLs, you had shadow banks with liquidity problems, you had households who had already taken on too much debt, didn't want to take on more debt very quickly. And then you had the government with a very elevated public debt number. So the balance sheets were already stretched. Nobody's been finding it easy to spend their way out of this crisis. Perhaps the only balance sheet that had some space was the central bank, the RBI, and the RBI has done everything it possibly could, from cutting rates to providing liquidity to regulatory easing. Meanwhile, even the government has stretched, beyond what it could potentially do and has given you the bare minimum stimulus, helping some of the more disadvantaged groups and small businesses. So I think we've had to strike a balance here. We couldn't go all out like other developed countries. We've done what we could, and now we'll have to just wait for the pandemic to take a step back so that economic activity can start coming up again.
Sure. Pranjal, in light of the India bond rates now higher than 6%, do you sense that we could see more of operation twists to come in if indeed there is no stability coming in anytime soon?
So, glad you asked that. Things have really changed from the first half of the year to second. First half was tough for the RBI. It had to manage two objectives. One is, how do you keep the rupee from appreciating a lot when there is huge amount of inflows into the economy? And second was, how do you keep domestic liquidity flush to support economic recovery? And it was able to manage the two fairly well. The problem going forward is that a third objective has come into the picture, which is how do you fund the fiscal deficit with huge market expectations that there will be a big OMO calendar. I think it's an extremely difficult time. It's tough for the RBI. It'll have to play a very good balancing act. But in my own view, I think RBI will manage to balance it off. It will buy some dollars to keep the rupee from appreciating more. It'll buy some bonds to help the government finance its fiscal deficit. LAF will be slightly elevated, but hopefully it won't be more than the record high that we were seeing in May. So hopefully there will be a way in which the RBI will be able to manage all of it. But the truth is that challenges are only rising.
Yeah, they are. So in light of the way the money markets have been going on, what is the view on both equity as well as the debt flows? As we've seen, FIIs have been big buyers in equities for the last few months now, but I can't say the same about the debt markets.
Well, look, that's a market technicality, but the truth is that central banks all over the world have been pumping in liquidity, and all of this liquidity is chasing returns. Equity markets in India has looked attractive to many FIIs, and therefore we've seen this sort of big rally in capital markets, which is not in line with the state of the real economy.
Okay, what's the extent of pain, Pranjal, that you see for economic activity? Because you have spoken about, the steep contraction that we're expecting in Q1. Of course, you mentioned that the pandemic needs to take a backseat for things to actually recover. But basis the kind of numbers that we're getting right now, the kind of economic activity that we're seeing with some, operations having been relaxed, how long do you believe we could see this sort of a contraction play out for the Indian economy?
Well, I do think that the quarter ending June, for which we get the data today, is probably the worst. But having said that, I think GDP growth is going to remain negative until the end of this calendar year, so until December 2019. Only in the Jan to March quarter 2021 do we think year-on-year growth will become positive. Of course, on the back of this, we also assume that activity will be almost normal come 2021. In terms of some of the sectors, I think the one which is doing the worst is non-government services. This is something that we've seen across the world, that services which tend to be slightly more high touch are doing worse than manufacturing. Manufacturing also will be contracting, but perhaps not as much as some of the trade and transport services, for the simple reason that manufacturers are also getting some sort of breather, by not paying your rents, by not paying salaries as you were in the past. They are being cut down. They are being able to cut down on costs, and therefore profitability hasn't fallen that much. The best sector of all is likely to be agriculture, because the national lockdown wasn't really imposed there, and also rains and sowing has been very good. So this would be the pecking order. Non-government services doing the worst, then manufacturing, and perhaps agriculture doing the best.
So what do you think would be the need of the hour right now? What would be more critical? Perhaps a boost in overall consumption right now, because you've got the aggregate demand that is well below perhaps spends on construction, real estate, infrastructure. Should that be perhaps a focal point?
Well, I don't think you can rely on consumption the way we have relied in the past couple of years, or perhaps the last decade or so, for the simple reason that, we've looked into this very carefully, and we find that while jobs will come back, most people will be employed again. They'll probably be employed at a lesser wage rate. So, wages is something that's going to give. And if wage growth is going to be weak, then demand is going to be weak, and India could very well be stuck in a low wage, low demand kind of equilibrium. So I don't think consumption can be counted upon that much this time. In my sense, I think if the government can give the right signals to support investment, I think that will be a very good step. Some of it is about the government putting on more money in the investment sector, which may not be very easy. But some of it is also about regulatory easing and also policy certainty, which over time attracts investment. So we can't really rely on consumption, but we should set the stage so that investment can come back, at least in the next couple of years.
Pranjal, great having you on board with your analysis of the GDP numbers. Many thanks for joining in with that take.